This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to, in this lecture, work through Chapter 6 of the free lecture notes for paper P2. And Chapter 6 is Divisional Performance Measurement. And so first of all, let me just explain briefly what we mean by a division, because some people tend to use the word division in slightly the wrong way. Let me give you an example. Suppose I've got a company, I'm in charge, and the head office of the company is in London, but we've got a branch in Manchester. Now I'm in London, I put somebody to manage the Manchester office, and I can do it in two ways. I can just say, your job as manager is simply just to make sure that the people turn up to work on time and that they're working efficiently and that sort of thing. But I'll make all the decisions from head office. So I'll decide who we employ, I'll decide what we pay them, I'll decide what we charge for our product and so on. Alternatively, and this is what really makes it a proper division, is I put someone in charge of Manchester, but I give them autonomy. One of the key words you may come across, autonomy. And what I mean is, I give them the power to make decisions themselves. And so, if it's a question of employing new staff, they don't have to come to me and ask my opinion. They can make the decision. Their job is to run it as though it's their own little company. They can make decisions. They've got autonomy. Now that's what makes it a division. And it can happen in several ways. It can be geographical, as my little example just then. Or it could be in terms of a product line or types of customers. You know, I can have managers in charge of each separate product in the same location. But what makes them divisional managers is they have the power to make decisions. They don't have to keep asking me. You know, that's why I've put them in charge. They've got the power to make decisions. Their job is to make their division do well. They're responsible for the performance of their division. And you've got on the first page, paragraph 2.1, advantages of divisionalisation. One is the first one, focus on specialisations, that the person in Manchester has better knowledge of Manchester than I do if I'm in London. The people in charge of individual products have more knowledge about their products than I do. They know more. They can hopefully run their division better. Greater motivation. It'd be very common to, we'll come to how we might measure the performance shortly, but very common to give them rewards, the managers, based on how well they perform. And on top of that, of course, if they're in charge of their division, hopefully they're more motivated to make it do well than if their job is simply to monitor what's going on. Faster decision making. They can make the decisions. They don't have to come to me and wait for me to decide. You know, it takes time. Enables divisions to be classified as profit centres. That relates to, again, what we're coming to, how we can measure how well each bit of the business is doing. We can compare divisions. Yet again, it's something we're coming to, how we might measure performance. But you know, we can compare this division, this product with that product and see who's doing a good job, how well we're doing and so on. Better objective system management. That each individual manager is just concentrating on one bit of the business and usually results in better decisions, well, for all the reasons I've said above. The manager's more knowledge of what they're in charge of and better performance. Problems over the page, coordination, different managers making decisions about different things. Transfer price, if we've got divisions that sort of trade with each other, if one division supplies goods to another division that then does work on, we're going to have to charge between them. That's something we'll discuss in a later chapter. Lack of goal congruence, again, as you'll see, I keep saying this, but you'll see what's coming. There can be a danger of the manager, they do what's good for their division because that's all they care about, which may not always be good for the company as a whole. Difficulty in comparing divisions. I said that one beauty perhaps is we are able to compare. Is your division doing better than my division, sort of thing? However, there can be problems in how we go about comparing, and it can demotivate if we don't do it well. Potential duplication. There can be the case when you've got different managers making decisions, similar decisions, which perhaps could have saved a bit of effort by one manager making the same decision for both divisions. Control purposes. We need measures of performance. Now, I'm not going to read all that to you, but if I'm giving you responsibility, autonomy to make decisions, I can't watch you every day. I can't every day say, what decisions have you made today? Oh, that was a good decision, that was a bad decision. I've got to leave you to it. But as a result, I've got to find a sensible way of measuring, perhaps at the end of the year, have you done well or have you done badly? You know, we'll come to the precise ways we might do that shortly, but ultimately I want your division to make more profit. I don't care how you do it. You know, maybe you decide to reduce prices because you'll sell a lot more. Fine. I don't care. I just want you to make the division better, but we do need a way of measuring how well the division is actually doing. I've said I'm coming to ways we might measure. We'll discuss the strengths, the weaknesses. But there's no point in just saying, oh, I want more profit. If profit goes up, I'll give you a bonus. Because that won't always work. You know, you might say, I can get more profit. If I buy a new machine, the profit will go up by 100 a year. That new machine costs 100,000. Well, I don't want you paying that much for a new machine just to get an extra 100 a year profit. But if I've said, oh, I'll measure you on your profit goes up, you'll get a bonus, well, that wasn't actually very sensible. But have a read of that properly. But we're coming to the way we might measure performance. Over the page, paragraph 4, there are, generally speaking, 3 types of division, depending on how much autonomy we give the manager. A cost centre is where the manager has responsibility, autonomy over costs, which may seem fairly obvious, but I'm allowing you to make decisions over the costs. You can decide what materials you buy and where you buy them from, what wages you pay your staff, and so on. But maybe I have responsibility over selling prices. You know, maybe it's like when I first said, we've got a business in London and we've got a division in Manchester, but if they're both selling the same thing, maybe it's important that we've got the same selling price in both places. And so I'll be responsible for selling price, you're only responsible for the costs. Secondly, a profit centre. Here's where the manager has autonomy over both costs and revenues. So fine, you're in charge of your costs, but you're also in charge of the revenue. You can fix your own selling price. You're responsible for everything. We call that a profit centre. And finally, and a very important one for what follows, is what we call an investment centre, where not only are you have you got responsibility, you've got autonomy over the costs and revenues, but in addition, you can make decisions about new capital investment. It's perhaps less common in real life, but it's important for what follows. That in the first two cases, costs and profit, fine, day-to-day costs, profit centre responsible for your revenues. But when it comes to capital investment, if you want to buy a new machine for 100,000, well, I'll make that decision at head office. An investment centre, though, is where I give you autonomy over not just costs and revenues, but also capital investment. I say it's less common in real life. In fact, in real life, what tends to happen very often is a limit's fixed that you can have new capital. You can decide on new capital investment, let's say up to 10,000. But anything in excess of any expenditure in excess of that, you need to come to head office, and I'll make the decision. But a full investment centre, you've got complete autonomy. If you want to buy a new machine, you buy a new machine. It's your choice. I keep saying we come into how we might actually measure the performance, but the sort of things you might look at, exercise 1 suggests some performance measures or ratios that might be suitable. If it's a cost centre, I'm only checking on your costs, obviously. I only check on what you're responsible for. And the sort of things I might look at are just the absolute figure, compare this year's costs with last year's costs or with budget. Things like cost per employee might be relevant. Individual costs, material as a percentage of total costs. There's no rule, but obviously if it's a cost centre, I'll be focusing on the costs themselves. Essentially, obviously the lower the better. A profit centre, all right, I will look at costs, compare costs year by year, month by month. In addition, I'll look at revenue, and look at profit margin, profit as a percent of sales. Obviously, we want that to increase. Percentage increase in sales. So again, there's no rules, but I'll look at that sort of thing. An investment centre, though, which is the big one for what's coming. I will be looking at costs, I will be looking at revenues, I will be looking at profit margins. But if I'm allowing you to make decisions about capital investment, I want to make sure that you're making decisions whereby I'm happy you invest capital, but I want to make sure you're getting enough profit on that investment. So we don't just need to look at profit. If you've had twice as much capital investment, I want twice as much profit from you. And so we have to have a measure relating what the profit you're making is to the capital that's been invested in new machines. And the two measures we look at, which is what shortly I'm going to explain, are something called return on investment, which I'll work through in a minute, and I think you'll find reasonably obvious, but something which is a bit less obvious called residual income. And when it comes to the numbers, as you'll see, it's these two measures you need to be happy with, ways of measuring performance in an investment centre. I find on paragraph 4, it mentions controllable and uncontrollable costs. If we're actually measuring the performance of a manager, whatever the type of centre, I think sensibly we should only measure them on the factors they control. And so you see, there's often limits on autonomy. Cost centre, I said, has autonomy over costs. Well, in general, yes, but I may not allow autonomy over all costs. It may be important in my business that all divisions are paying the same level of wages. Or, okay, different employees, skilled, unskilled, but perhaps the same pay rise. We can't have one division giving people a pay rise of 10% if the other division's only giving 2%. Well, if that's the case, maybe I'll determine wages, because they have to be standard around the company, and I give you autonomy over all other costs. So we're not necessarily giving complete autonomy over all costs or over all revenues and so on, but it is only fair that if I'm measuring how well you're doing as divisional manager, I'm only looking at the factors you control. So if wages were controlled by me, when I come to measure your performance, I'll exclude wages from any ratios, any calculations, and so on. Okay. I've said several times, although all the discussion we just had stands to be relevant, when it comes to numbers, it's really investment centres that we need to think of, because it's for investment centres that it's not immediately obvious how we're going to measure performance. And I mentioned that these two ways, return on investment, residual income. Let me explain with an example what they are and then why, what's good, what's bad. Look at exercise 2, if you would. Arcania plc has divisions throughout the Baltic states. The Ventspils division is currently making a profit of 82,000 a year on investments of 500,000. Their machines, whatever. Arcania, which is the whole company, has a target return of 15%, which is perhaps the company's weighted average cost of capital, which I think is something you should have heard of, but isn't directly relevant here. But that's their target. For whatever reason, our company, Arcania, wants to make sure they get a return in excess of 15%. The manager of Ventspils is considering a new investment which will require additional investment of 100,000 and generate additional profit of 17,000 a year. It'll enhance the product, it'll improve brand reputation. A says, calculate whether or not the new investment is attractive to the company as a whole. Well, as far as the company is concerned, it says we have a target return of 15%. If this investment's giving more than 15%, we're happy. If it's giving less, we're not. And so what return is the project giving? Return from investment? Oh dear. Well, we can do it in our head, but even so. The return is the profit per annum. It's giving 17,000. On the capital investment of 100,000. It's giving a return, an expected return of 17%. Our target again for the company is 15%. And so as far as the company is concerned, we want to accept. No problem. However, we're divisionalised, and so it's not me making the decision, it's the manager who's making the decision. And so part B says calculate the ROI, return on investment, for the division, with and without the new investment, and determine whether the manager will decide. Now think about this, you see, I'm letting the manager of Ventspils make the decision. And how he makes the decision will depend on how his performance is being measured. And I've said that we're going to measure the performance based on return on investment, or ROI. And let me explain what this is. You see, the Ventspils is currently making a profit of 82,000. I wanted them to make more profit, but it's a bit, I referred to this earlier, there's no point in just saying we'll measure you on profit, because of course then any machine, as long as it increases the profit, even if it only increases the profit by 100, then profit's gone up. If I'm measuring purely on profit, it's doing well. And so because it's an investment decision, we'll measure performance based on profit as a percent of the investment. And so it's the profit as a percent of the total invested. And so every year, perhaps, I'll ask the divisional manager to bring me a set of accounts. I'll calculate the return on investment. So I'm trying to write a bit neater. If it's gone up, the manager's done well. If it's gone down, he's done badly. But remember, I'm not going to check every decision day by day. I don't care how he improves his measure. If we can make more profit by increasing prices, fine. The percentage will go up and he deserves a reward. If he has a new investment, no problem, provided the profit goes up appropriately, that percentage increases. And so when the manager's deciding, shall we take this new investment or not, the manager will be saying, well, if I don't take it, what's the return on investment? Currently, we're making 82,000 on investment of 500. So currently, the division's reporting 82 on 500, 16.4% return. All the manager cares about is, can we improve that or not? If that goes up, good. If it goes down, bad. And so in deciding whether to take the investment, the manager will say, what will the new return on investment be if we acquire this machine? Well, the profit will go up by 17,000 a year. So it was 82, it'll go up to 99. The capital invested on the balance sheet, the statement of financial position, will go up. It was 500, it'll go up by 100 to 600. And what will happen to the return on investment? It'll go to 16.5%. And so, what will a manager do? All the manager cares about is what they're being measured on. And so, compare the two. 16.5 is greater than 16.4. Therefore, the manager will accept or will invest. And so things are wonderful. Remember, the company actually wanted that investment because it's giving more than target. However, it's not head office making the decision. We can't impose the decision on the manager. We've given him autonomy. And so the manager simply looks at what will be the effect on the return on investment, because that's what they're being measured on. Here it's gone out the accepts. So the manager is making a decision that the company wants. We call that goal congruent. Goal is aim, congruent means same. The same aim. Manager makes the decision, he will invest in this machine, and that happens to be what the company wanted him to do. Now that may seem perfectly obvious, and it should be a very obvious way of measuring performance. However, there can be problems. So look at exercise 3 over the page. It's exactly the same information, so you have to look back at exercise 2 in a minute, but this time we're considering a commercially worthwhile investment which will cost 100,000, and this time we'll give 16,000 a year. And like before, first of all, does the company want it? Well, the investment is giving a profit of 16,000 on 100. It's giving 16%, and remember, the company as a whole is happy with any investments giving more than the target of 15. 16 is more than 15. The company wants it. But just like before, we've given the manager autonomy. It's not the company who will make the decision, it's the manager. And what will the manager do? All the manager cares about is his performance measure. The current return on investment. I know we did it before, but to save me winding back. Currently, if they don't do this new investment, presumably they'll carry on getting 82,000 a year on an investment of 500,000, which is 16.4%. The division's doing quite well, obviously. Some divisions do better, some worse. This is doing quite well. It is making more than the company's target. But that's what it's being measured on. If that goes up, he'll get his bonus. If that goes down, he's performed badly. And so what will happen to the return on investment if he takes this investment? If he invests in this new project? This time profit goes up by 16,000, so it goes to 98. The capital invested was 500,000, will go up by 100 to 600,000. And so 98 divided by 600, return on investment goes to 16.3%. Now it may only be a small change, but this is all the manager cares about, because this is how I've told the manager we're going to measure his performance. And since taking on this new investment will mean the performance measure, the return on investment, falls, the manager will not invest. And there is the potential problem. There isn't always this problem. But here, we've got the company wanting one thing. We want to do the investment. But the manager doesn't make the investment because of the way we're measuring performance. It's not goal congruent. Now, some people say, well, why don't we just tell him he must invest in this new machine? We can't. We've given him autonomy. We can't say, you've got responsibility for everything. But I'll keep pushing in and saying, oh, you can't do that or you must do that. We can't do that. It's demotivating. And also, the manager's making lots of decisions every day. They're making decisions about selling price, costs, new investments. We can't keep day by day checking what they're doing. We either give them autonomy or we don't. It's the obvious way of measuring would appear to be the return on investment. And fine. If they make more profit by increasing selling price, profit goes up, return on investment goes up, no problem. But there is the possibility of this sort of thing happening when it's an investment centre, where you get the manager rejecting an investment which the company as a whole wants. And in fact, it can work both ways. You see here, because the division is currently earning more than target was 15, then anything giving, the manager is going to reject anything less than 16.4, even if it's still above the target of 15. You see my point? Now you could have other divisions, maybe with another division, which is currently only getting 13%. You know, they're below target. Well, I want the manager to improve it, you know. I put a new manager in. But they're currently getting 13. And I've told them, anything more than 13, you'll get your bonus. Well, suppose there's a new investment, which gives 14%. The manager's going to want that. Because if he's currently making 13, a new investment is going to get 14, it'll push up the return on investment. The manager will want to accept. But the company doesn't want it. They don't want us to take new investments that they're giving less than the target of 15. So again, there's not always a problem, but I hope I've made it clear why there could be. Which is why there's a second standard measure, which is called residual income. Which is a bit less obvious. It's easy enough arithmetically, just a little bit less obvious. And remember, we want to measure profitability, but when it's an investment centre, we have to relate the profits to the capital invested. Which, although I've shown you how there can be problems, return on investment does, because we're looking at percentage. What we do with residual income is we call the manager in, perhaps at the end of the year, get the manager to bring a set of accounts for a division, and then we come up with a performance measure. And to show you, exercise 4 says repeat examples 2 and 3. So I'll go back to example 2 and use this to explain how we calculate residual income. With example 2, residual income, we obviously do want more profit. So we take the profit from statement of profit and loss, you know, the ordinary accounting profit. And sorry, I beg your pardon. We'll look at what the current residual income is. Without the investment. And then, with the investment, does it improve? Would he want it or not? We take the profit. And if the manager doesn't do the new investment, the profit is 82,000. But to relate it to the capital it's invested, we subtract what we call notional or imputed interest. Now, the reason we call it notional or imputed, we're not actually going to charge interest. This is purely done as a bit of workings to measure the manager's performance. You know, at the end of the year, I'll take a piece of paper and I'll do this arithmetic. And this interest, the interest we charge is the target or the cost of capital, 15%. That's my target, the company's target. I've told the manager that it's 15% we're going to notionally charge. Notional means pretend. And we apply that to the capital employed. Without the new project, there's investment of 500,000. And so when I come to measure how well he's doing, I subtract 75,000. And the difference, the 7,000 that's left, is the residual income. Now again, this interest, there's no actual invoice for it, it's not actually charged, it's purely to be able to get this performance measure. And I've told the manager, he knows in advance that at the end of the year, that's how his performance will be measured. We'll take the profit, we'll subtract 15% of the total investments. And that figure that remains, if that goes up, he's done well. If he goes down, he's done badly. So still an example 2. The manager, if they're being measured this way, they're going to say, well, if I take the new investment, what happens to the residual income? We know the profit will go up. In example 2, it goes up by 17,000 to 99,000. But he also knows, because there's been new investment, he knows this notional interest will go up. It'll be 15% of, well, the new capital invested, there's an extra 100, 600,000, which is 90,000. There's the performance measure, 9,000. It's gone up. Therefore, he's done well. Because it's gone up, the manager will accept, will invest. And that was example 2. Remember, example 2, on return on investment he wanted to invest. We've got goal congruent, whichever measure we use. But now let's look at example 3 on this measure. Because again, if you remember in example 3, if we were using return on investment, we lose goal congruence. The manager ended up rejecting an investment which was good for the company as a whole. So, last bit, let's repeat example 3. It's exactly the same as before, so without the new investment, the current residual income, I won't do the workings again, we just did it, they're currently making 82. Without the new investments in total are 500, so interest 75, the residual income 7,000. But again, he's in exercise 3, the new investment costs 100,000 and gives extra profit of 16. Making the decision, the manager will look what the effect will be on the residual income. And if they do take it, the profit will go up. It was 82, goes up by 16 to 98. So the profit's gone up by 8,000. But the interest will go up. It's 15% always, so whatever the total investment is. It was 500, and another 100. There's a total of 600. And so the interest goes to 90,000. The residual income, it's gone up. And why has it gone up? It's because this investment is earning more than the 15% target. And so this time, if he's being measured on residual income, the manager does want to invest. And of course, if you look back, that's what the company wanted anyway. It is goal congruent. this measure is not a perfect measure. There are problems I'll come to in a minute, but I hope you can see what you might call the benefit of it. That without us having to take away autonomy, when it comes to new investments, with return on investment, with residual income, the manager is motivated automatically to take new investments, provided they give more than the company's target of 15. So that's how it is. Arithmetically, they're not hard. I say residual income looks a bit unusual first time round, but I hope I've made sense of it. Over the page, there's a few things comparing the two measures. Appreciate they are accounts measures, so we are taking the profit from the profit statement. We're taking the value of the investments from the balance sheet or statement of financial position. And so they do both favour divisions with old assets, because of depreciation, older assets will have a lower value on the statement of financial position. And so automatically, those divisions would have a higher return on investment and residual income. Also, they're both based on profits, as I've said a couple of times, rather than cash. And so things like accounting policies, if different divisions have different policies, that could affect things. The strengths and weaknesses. Return on investment is similar to return on capital employed, which I think you should have heard of, but we're looking at ordinary financial measures in a different chapter. But managers tend to understand them better. You know, most people, even non-accountants, can fairly rapidly get, I'm sure I wasn't minding that, but get the idea of return on investment. It seems much more logical. Residual income, even though I keep saying it's not hard, it certainly isn't as obvious to people. We can compare with target. It says there, shareholders often judge the company based on return on capital. And return on investment is effectively the same idea. It's also useful when you're comparing divisions of different sizes. You see, if you've got one division which is fairly small, another one that's very big, then automatically the big division is going to make much more profit and get a higher residual income. And it doesn't actually mean the manager's performing better just because the division's bigger. Whereas return on investment, because it's a percentage measure, it is better when you're comparing divisions of different sizes. But it may lead to dysfunctional decision making, a lack of goal congruence. That's what I've been hopefully making clear. Residual income. It tends to be congruent with decisions that maximise shareholder wealth. It's more closer to discounted cash flow approach, which again is something we're covering later, even though I think you should have heard of it. Although we are looking at profits. And, now that's interesting, the notional interest rate, although we want to achieve the company's target, so here it was 15%, we can actually, different divisions have different targets with the different levels of risk, you know. If they're taking on what we think is a very risky investment, we could perhaps say we're going to apply a different percent. But it's less familiar, we've said that, and I've already said it's not good, it's not useful for actually comparing two divisions when they're of different sizes. Okay, so that was quite a long one. Sorry talking so much. There is one other thing in the chapter, which is economic value added, where there is a similarity. But I'm going to pause here. The second of 2 lectures on this chapter, I'll explain and go through economic value added.